how our Canadian tax system is structured to provide you with tax credits in order to reduce the tax you pay. And it always astounds me how often people get worried about reporting all of their income, but they don't realize that if they reported all of their tax credits, they might not pay any tax at all. So that's having been said, the agenda for today is who's involved when it comes to families when we talk about tax, what's so complicated about tax, and why this topic today. Why do medical expenses matter? And I will go into that one in probably a fair amount of detail, because medical expenses are expensive. And if you're paying for medical expenses or even paying the premiums on medical insurance, you're going to want to hear what I have to say in this section. Where do you find the information you need so that you can look it up yourself? And when can you go back? In other words, can you go back if you hear something today that you go, oh shoot, I should have been able to claim that. Now I'm going to explain to you in that section how you go back for as much as 10 years. That's right, 10 years to make a claim. I feel like I'm sounding like Tom Vu on the midnight television commercials that used to be on. But you can go back for 10 years. And how do you get started with your taxes? I'm going to be working through some example tax returns today, and that I'm hoping will make it fun. The first thing we're going to look at is that tax preparers in Canada are now regulated, and they're going to be registered soon. Right now they're regulated in that they are required to file your return electronically if they prepare more than 10 returns. So if you're a family member who prepares 10 returns for your family, you may find that you get a fine for the 11th return. So you might want to be careful when you're filing your family returns. If you're putting your preparer name on them when you're e-filing, you may find yourself with a penalty for preparing more than 10 returns. But I think it's for money. So if you're not getting paid, I don't know that it's a problem. You can find out more about that, and I'm going to occasionally flip to the Canada Revenue Agency website to show you how to find something. And I'm going to put in the search box up here in the top right hand corner, I'm going to put RC 4018, and that is the Electronic Filer's Manual for 2013. And when I'm talking about the rules for preparers, they have responsibilities, and there's 12 of them. And the one that I want to focus on today is this one right here, because it's really important if you're having a preparer prepare your return, because they have to live with these rules. And if they don't live with these rules, they can't electronically file your return. And the first one is that I consider probably a damning blow for the family member who normally prepares all the returns for everyone and has somebody do it for them, like electronically file. That person is going to get a shock this year when their preparer says to them, I need to see every taxpayer that I do a tax return for. I have to deal directly with that person. I can no longer have dad show up or mom show up with everybody's paperwork and not see anybody. At some point, when they go to sign off on their tax return on the T183 form, before they file the return, they have to deal directly with the client and have a conversation with them and review their return with them. So that might be an interesting thing to take into account when you take your stuff to H&R Block or whoever it is you take it to. You may find that they say to you, nope, need to see everybody. And those rules have become, they were always there, but this year have become much more enforceable because there's a fine for not filing electronically. Before they could file your return manually and get away with it, now they can't. Slips and other documents from which the return was prepared must be seen. Verify the authenticity of these information slips before conducting financial transactions. That means when you go see your tax preparer, you can't take your little piece of paper that has a bunch of numbers scratched on it to have them put in the tax return. You have to take the documents from which those numbers are taken and have them in some sort of order for the tax preparer to look at them. Now, do they have to check your math? Absolutely. They have to check your math. And in fact, I've gone so far as to say that when you come to see me to do your taxes, I want to see all your bank statements and your credit card statements, because I want to verify that your net pay agrees to your T4 slip. In other words, that there isn't more deposits on your bank statement than what your employer has provided you net pay for. And if there is, we better look at it, because Canada Revenue Agency at their last meeting with accountants in Vancouver announced that they're going to indirectly verify your income by asking you for your bank statement. So if you hadn't thought of it in those terms before, this might be a real wake-up call that your bank statement tells a story that could be quite different than what you're filing on your tax return. And if your bank statement does tell a very different story, you need to be able to explain that. I suggest to people that what they do is they complete have a package of all of their accounts, and that they write on those statements the explanation for each deposit. And that doesn't take all that long to do. To go through 12 months of bank statements and look at what the deposits are and analyze what they are, now you probably still remember. In 3 years, when Canada Revenue Agency is auditing you, not so much. It's not so easy to recall that your mother-in-law gave you $5,000 toward the kid's wedding 3 years ago. So make sure that you've documented the source of all of your deposits. Enough on that topic. Let's keep going, because I have so much more to say to you. The next thing that's really important to know is that your preparer requires to verify your identification. So I suggest that you have 3 pieces of valid ID. And why is this? Because we have a huge problem in Canada with identity theft. And people could steal your tax return refund. I know that sounds bizarre, but it's happening. It's happening in the States. It's happening in Canada. If you're not careful about protecting yourself, you may find that somebody files your tax return for you and takes your refund, and you'll have a heck of a time convincing them it wasn't you. So have your identification. Also, you'll want to very seriously consider monitoring your tax situation on Canada Revenue Agency's My Account. So let's go look at how you get to My Account. Let's go to Home on the Canada Revenue Agency website. And you can log in or register to sign up for My Account, My Business Account, or if you're representing other people. For example, you are the person in your family who manages everybody's taxes. You might want to become a representative. And if you do represent other people, you have responsibilities, but you can access their tax return information and their carry forward balances. And this year, many of the software companies now allow you to download the carry forward information directly into the software. So you could carry forward all of their losses and their education credits, all those kinds of things in the software directly. But even just to look at tracking your own refund and viewing and changing your return and checking your RSP limit and your TFSA limit. Those kinds of things you can do yourself in My Account. The instructions are all here. You just go to the Canada Revenue Agency website and go in under the home page to the very top thing, I want to log in, register. It takes about a week to set this up. And while you're in there, check to see who represents you at the moment. Because if you've ever gone to a tax preparer, you may find their name is still on your file, and they have been able to access your information for as many years as it's been since you last saw them. And that preparer has no way to take their own name off at the moment. That's coming. In April, apparently, Canada Revenue Agency will allow us as representatives to take our names off of accounts where we have been placed on the account by the taxpayer in the past. that was done through a T1013 form. The T1013 form has the ability to remove and or authorize and cancel a representative, and that form can be used to take someone off, or if you're logged into my account, you can just remove that person as your representative. So you might be shocked to find there's a dozen people who've been able to access your tax information for years. So please sign into my account, go and check who represents you, and take off the people you don't want to be able to have access to your information. Now, if that hasn't shocked you into being awake this morning, oh my goodness, that's pretty strong stuff, because your identity could be stolen, someone could steal your tax return and refund in advance. And Canada Revenue Agency has a verification of slips program, but it isn't active right at the time you file. It's months later. They verify your T-slips in the summer. That's why you get an audit letter months later saying you didn't file this T4 slip. Even though they got them in February and they were probably delivered electronically, they don't get around to cross-matching your slips with what you filed until August. So when you're looking at your T-slips and you're wondering why the tax preparer is required to verify the authenticity of your slips, well, it's because Canada Revenue Agency doesn't do that for quite a few months. And if you're missing a slip, the fines and penalties under Section 163 of the Income Tax Act, if you miss out on reporting income for a number of years, the penalties get really gross, and they're called gross penalties for a reason, because they are based on the amount of income not reported, not the tax owing. Even if you don't owe any tax, they will still assess you a penalty if you don't report the income, because the income goes to calculating your benefits from government benefit programs, like, for example, medical programs and various health and welfare programs, child tax benefits, all those kind of programs, your old age security, your GIS. It's calculated based on your income, regardless of whether you pay tax or not. So if you're not reporting your income on your slips and they don't catch you doing it and you don't correct it for 3 years in a row, you're going to find some horrific penalties. Tax preparers must deal directly, must require proof of identification, must see the documents and slips, and must question the authenticity of those documents, and that they're all, and to gain access to her apartment to be able to deal with her paperwork and to wrap up her affairs and even just to clean out the fridge. So it's important to know that it's necessary to validate who you're related to. And if your family doesn't have a genealogy tree, you might want to consider who in the family should be preparing one, because at some point somebody may be saying, prove that this is your grandfather. When grandpa moves in with you and he's an old geezer and he decides to come live with you and you think, oh great, I'm going to claim tax credits for grandpa. Well, prove that grandpa is your grandpa. Can you do that? I don't know of any paperwork that would prove that. So think of ways to document who's in your family, because you may need that one day. Now, before we can play, we need to figure out who's on the team. So figuring out who's related and can you claim them is a really interesting thing to do. And you'll notice down the side I've got son, daughter, grandparent, grandchild, brother, sister, aunt, uncle, nephew, niece, father, mother, grandfather, grandmother, great aunt, great uncle, son-in-law, daughter-in-law. Those are the family for whom you could claim tax credits if the circumstances warrant it. And the circumstances that would warrant it would be that in most cases they live with you or you support them in some way. And the support must be for basic essentials that they can't afford to pay for themselves, including food, clothing, and shelter. We're not talking Gucci. We're not talking if the family member has substantial income. We're talking basic essentials. You also must be purchasing those essentials directly. You can't give the person money and expect that they will be able to claim, that you'll be able to claim. So here's a chart, just to take a second to take a look. Here's grandpa, aunt, dad, mom, niece, nephew, daughter, son-in-law, grandson. The nanny you can't claim. On the other family tree here, we've got the great aunt, the grandpa, the grandma. We've got the live-in caregiver. We've got the girlfriend who isn't common law from grandpa. We've got the son and daughter of the girlfriend and the grandson and the child of the niece. So there was actually a question on LinkedIn this week in my tax group that I belong to about the child of a niece living with the aunt, and she wanted to know, because the child was disabled and the niece was disabled, could she claim for the autism early prevention treatment for the child as the aunt, because the aunt was paying for the child? No, she can't, because she could claim for the niece but not for the child. Now, something to keep in mind here is that the niece and the child get what's called persons with disabilities benefit from the province. So those people are getting tax-free money that they're supposed to pay some of it to rent for the aunt, and the rest is for their own personal needs. Now, if that's not sufficient, if the niece pays for the child's costs and the aunt pays for the niece's costs, you get me? So it matters who pays for what for whom. Now, something to remember is that Canada Revenue Agency has rules about marital status changes because all these programs rely on the date of the change. And it's necessary to complete an RC65 and submit paperwork along with that RC65. And I'm going to go to the Canada Revenue Agency website, RC65, Marital Status Change Form. And this form is fillable. You can actually go online and create a PDF. Okay, so the RC65 is the form you need to use, and that form requires that you submit documentation. So your separation agreement goes to Canada Revenue Agency. Normally, you have to report any marital status changes by the end of the month following the change, and the change will be backdated and you'll have to pay back benefits if you receive benefits. For example, if you receive child tax credit benefits. Now, if you're separated, you don't report for 90 days. But in any other circumstance, you report within the month following the month of the change. Canada Revenue Agency requires documents to validate your support of other people. If you're in receipt of child tax benefits, they require you to submit information about your marital status, your residency, and who the primary caregiver is. And that information can be found under the benefits, validating your eligibility for benefits and credits. If you search for that on the website, you'll find more information about that under their website. So what's so complicated about tax? It's just a tax return. You can go online and do your own tax return in no time at all on TurboTax and UFile. Well, that's great, but what if it goes way beyond calculating just your income from all sources? And by that I mean all worldwide sources, not just Canadian sources, but your worldwide income is subject to tax. And of course, if you've paid tax in a foreign country, you can get a foreign tax credit in certain circumstances, depending, of course, on the treaty. So less expenses comes to net income used for the social benefit calculations I talked about it earlier. less some adjustments where we take back off the social benefits that were included here, because if you received persons with disability benefits or WCB benefits, you would be able to deduct them back off before you get to taxable income. And we're going to go look at a tax return in just a minute. Times the tax rate equals your tax payable, then you deduct the tax credits, which are calculated based on the lowest tax rate to come to your tax payable. So let's go look at what that looks like on a tax return for somebody. So let's go look at this person. We'll look at a couple returns, but let's go look at Marion Abbott first. And let's go look first at Marion is born in 1954, so she's 59 years old. She's going to be 60. Well, actually, she turned 60 in January. And Marion, I'm just going to fill in some boxes here so we get that out of the way. Marion lives in Vancouver. She's divorced, and Marion has some dependents. She has a daughter, a grandmother, and a niece. And Marion has all three of her dependents that live with her have a disability. They are infirm. One can't speak, one has early onset dementia, and one has a head injury. You can imagine that Marion's probably pretty stressed and doesn't have a lot of income because she's having to look after three people. Now, the daughter, who's born in 2003, is, what are we at now? 2014, she's 11. The niece is born in 1975, she's 39. And the grandmother is born in 1930. So what do we get in the way of credits for these three people so that Marion, if she did earn any income, wouldn't have to pay tax? Well, Marion gets a basic personal amount for herself. She gets an amount for the eligible dependent. Now, who's the eligible dependent? Let's take a look here. One of these people is the eligible dependent. There, this daughter here is the eligible dependent, and she also, if she qualifies for the family caregiver amount, I'm just wondering why that didn't go to 13,000 like it should have. Okay. So she gets, oh, it's probably coming in under the family caregiver amount because you can only claim the extra $2,000 on one line. Okay, so she gets the amount for an eligible dependent. She gets an amount for a child plus an infirm amount for that child. And I'm going to show you how these are all calculated in a minute. She gets an infirm caregiver amount for several of the dependents, a Canada employment amount because she has some benefits, and she gets a bunch of transfers from other people's disability amounts that they can't claim. Marion can claim $59,000 worth of credits at the federal rate of 15% plus an additional provincial rate of 5-something%. So she can basically earn almost $60,000 before she has to pay any tax at all. How does that come about? Well, let's go look at a TD1. A TD1 is a form you're probably familiar with if you've ever been employed. A TD1 is the form you fill out for your employer. And there's a federal, I'm going to backtrack for a second, there's a federal and then there's provincial worksheets for each province and territory. Each one is different. Everybody has their own personal tax credits. It doesn't hurt at tax time to go review these sheets for the previous year. Like this is the ones for this year that you would fill out for your employer while you're working during this year. This is what it looks like. So there's a basic personal amount that every person gets. Then there's a child amount, an age amount, a pension amount, tuition, disability, spouse or partner, other eligible dependent, caregiver, and then there's also, and I'm going to find the other one that I did that's more detailed. Just a second. here. There's also an infirm amount for a dependent age 18 or over. And what you'll notice on the TD1 is that every time the person, and there's 5 different categories where this happens, if the person is considered infirm, I-N-F-I-R-M, infirmity takes its definition from the dictionary, and the dictionary says that if someone is weak or feeble, that they are infirm. And if they are infirm, they get an extra $2,058. It started at $2,000 and it's been increasing each year along with the credits each year. So if you have a child that's infirm, you get an extra $2,000. If you have a spouse that's infirm, you get an extra $2,000. If you have an eligible dependent because you don't have a spouse, you get an extra $2,000. So that's what we used to call the I forget the terminology. It used to be called something about you didn't have a spouse, so you have a child that you use instead. It's an equivalent to spouse, it used to be called. And then there's the caregiver amount. If you have a parent or grandparent age 65 or older whose income is between $15,000 and $20,000, there's a partial claim. Or any relative 18 or older who's dependent on you because of an infirmity, they get $65.88. Then there's the infirm dependent 18 or older, and that's where you support an infirm dependent who may or may not live with you but lives in Canada. So you cannot support a relative in another country and claim this credit. Okay, but if they live in Canada and they live on their own, it's possible that if you support them, and again, remember, support is about basic essentials that you pay for directly to third persons. You don't give someone money, you give them support. And the support must be for basic essentials, food, shelter, and clothing. So going back to that tax return, I'm going to open up the profile return. Marion could earn as much as $59,000 before she pays a single dollar of tax. Now let's go look at a different example. Let's go look at some seniors, because I want to move along here to medical expenses, because I know that there's probably a lot of people on this call who have expenses that include medical. And that could be dental, it could be these glasses, it could be different forms of eye care, it could be any one of 150 plus different medical expenses, and I'll explain where to find those and how they're claimed in just a second. So you've been looking at Bill and Betsy Bones here. They've got old age security, so obviously both of them are over 65. They have decided to split their Canada pension plan, and neither one of them gets the maximum because they both started collecting at age 60, so they get a lower amount. Even though they contributed the maximum, they get about $8,500. Bill was a teacher, so he has a teacher pension, and Bill is splitting his teacher pension, note the split pension deduction down here, with Betsy. So Betsy gets half of his pension, plus she would also get half of the tax he paid. And they have some taxable dividends and interest income. And I don't have time to get into anything about investments today. That would have to be a different workshop, but suffice it to say that there is some investment income. Now notice that because Bill split his pension with Betsy, that Betsy gets a $2,000 credit, as does Bill. So in addition to their basic personal amounts and their age amounts, now notice that Betsy's age amount is more than Bill's age amount. That's because Bill's age amount gets clawed back because of his total income. So at $56,000, he's already starting to get a partial clawback on his age amount. That's not on his old age security, that's on the age amount on his TD1. And in addition, Bill has a disability. Now, because Bill has a disability and they hire an attendant to help with Bill, Bill can claim, or Betsy can claim, depending on which has the best position, because medical can be claimed by the most advantageous spouse. So in other words, medical, you choose to claim all of the medical expenses with one person in a spousal or common law relationship, and even though they were paid by the other spouse, they're claimed there. Now, children up to 18, same thing. Children over 18, where you're supporting them, you might find that you can make claims for medical expenses on line 331, net of that person's 3% of their line 236 on the tax return, to a maximum of $21.52. Now, this is probably one of the biggest mythbusters on today's workshop. Let's talk about this line right here, because I can tell you that in 30 years of doing tax returns, and yes, I am that old, that I have come across so many people who think that the most I can claim is $2,100, because they read that and they think, oh, well, that's not worth much, because $2,100 times 20%, because 15% federal and 5% provincial, $2,152 times 0.2 is $400. Well, even $400 is a lot of money. But let me put this in a totally different perspective, okay? Take your eyes away from the screen and think with me for a second that you have an uncle who's in Texas and he's having open heart surgery. Now, Uncle Fred has $1 million in income. Uncle Fred's open heart surgery, on an emergency basis, he couldn't get back to Canada. His heart gave out on him, so they're doing a shunt, and it's going to cost $100,000 for that surgery. How much can Uncle Fred claim against his $1 million income for medical expenses? Well, Fred can claim everything except for $2,152. So Fred can claim $97,000 whatever. The formula is 3% of line 236. Let's go back and look at what line 236 is. Line 236 is your net income. So that's your income minus these deductions. 3% of that line, let's go look at how much that is. 36,149 times 3% is 1,084 for Betsy. Okay, so when I go down here and look, there's the 1,084. If we claim $10,000 of the respite care for attendant care for Bill, because they have someone come in to manage his personal care, because Betsy just can't do it anymore, and they pay for medical premiums to a private health service plan, like they pay Sun Life or Blue Cross for extended health and dental coverage, for example, or even just extended health coverage for their prescriptions. They can claim the $1,300 plus up to $10,000 of the $12,000 they pay for attendant care, and they can claim everything over 1,084, because Betsy's 3% is slightly less. I just flipped to Bill, which is why the screen went blue and the totals went away, because I'm now on Bill's return. And on Bill's return, you see the medical expenses, but you don't see a total. And that's because at the top, I've optimized the expenses, and the better person to claim it is Betsy, because her deduction of 3% is less than Bill's. Okay, now sometimes what happens is the best option is to split the medical expenses. Because the pension tax credit, because of the split deduction on the pension income, the better person to claim the medical expenses can sometimes be a bit confusing, and you may have to experiment to see how to reduce your medical, or how to claim your medical expenses to best capitalize on those numbers. It's not always the case, but it does happen. I've had it happen where it's better to split the medical. But usually it's not, because when you combine them, this number only gets deducted once. If you split the income, there's two amounts there, but it might be because you can just type in the search box line 330, and that will bring up exactly the same things. This page provides you with, and I'm going to do that Control Plus thing to make this bigger, which medical expenses are eligible. There's a list of which medical expenses, during which period must the medical expenses be paid to be eligible. You can claim your medical expenses in any 12 months that end in the year. So if you happen to have a bunch of expenses in November and December of one year, and then more medical expenses the following year, for example, maybe you paid for something over an extended period of time from your dentist or your eye doctor. You had some eye surgery and you paid for lenses and it was $6,000 and you paid half of it in 1 year and half in the next. You could combine them and include it in the second year. So it's important to remember that, because it's an extra little added benefit that sometimes there wasn't enough to claim in 1 year. So never toss your medical receipts. Always keep them in your tax file, because you may find that the next year you can add last year's receipts to this year and claim for 11 months this year and 1 month last year. You just can't claim it, whatever you claim, twice, but you can arrange your affairs to claim your medical expenses in such a way that it's the most advantageous for you. Now, which medical expenses are eligible? I said there was 150 of them. Well, you can select a letter, or you can go down through the list, and I'll just go down a page at a time so you get an idea of the number of different expenses that you can claim. Okay, there's seriously 150 different kinds. I went through the Income Tax Act and added them up one day because I wanted to know how many there were. It's another story, but that's the way it is. I won't go there. I'm trying to figure out why this screen is doing what it's doing. Okay, so going back to medical expenses, how can I find them a different way? I can go to M and look up medical expenses eligible for dependents on line 331, for self, spouse, or common law partner and dependent children, non-eligible, refundable supplement. If you paid for medical expenses, even though you didn't pay any tax, you might find in certain circumstances that you qualify to get a refund of about $1,000. So always put your medical expenses on your tax return, even if you don't have any tax payable, because this refundable medical expense supplement may come into play. All of these credits can impact your net pay right now, not next April. We're in 2014. You don't have to wait until 2015 to get a refund. If you should be claiming for supporting someone else, you can submit a federal and a provincial for your province TD1 to your payroll clerk and have them take less tax at source right now. It might make a difference if you didn't have to wait till next April of 2015 to claim a refund. Now, not all of the tax credits show up on a TD1, and there's a reason for that. The TD1 has your basic, your child, your age, your pension, your tuition and education, your disability, your spouse, your eligible dependent, your caregiver, your infirm over 18, your spousal transfers, and your transfers from dependents. What it doesn't have is all of these things. It doesn't have your RSP contributions, your child care expenses, your sport payments to a spouse, your employment expenses, your carrying charges and interest on investments, your charitable donations, your rental losses, your medical expenses, your moving expenses, your self-employment losses, and your capital losses carried back. There is a form that allows you to ask Canada Revenue Agency to have your payroll clerk take less tax at source if you've completed a T1213. what you have to do is estimate your taxes in order to request that from payroll. You have to estimate your taxes, submit that form with the estimate to Canada Revenue Agency, and then they will give your payroll administrator permission to take less tax at source. I have used this, for example, where a parent is paying spousal support, that's a lot of spousal support, and they're paying a lot of tax and they can't afford to make the payments for the spousal support. So we've been able to reduce the tax at source so that they could afford to pay their spouse. Now, I haven't talked about the disability tax credit yet. I wanted to, and we're going to go there right now. The disability tax credit is something that you can claim, and you've probably heard about this in the news, and it can make you eligible for the Registered Disability Savings Plan. Now, why would you care about that? Well, there's $90,000 sitting on the table. And if you're not opening an RDSP for a person who qualifies for the disability tax credit and who qualifies for the RDSP, you're missing out on the potential for $90,000. That's huge. Now, the Senate committee, and I've got this up on my screen, the Senate committee released a report this week, and that report is this report right here. I'll explain to you how to get to this report in a minute. The Registered Disability Savings Plan program, why isn't it helping more people? Apparently, the uptake on this report is severely limited because the provinces and the territories have not enabled people who have a disability to access this program for a number of reasons, and they've outlined the reasons in this report. The fastest way to read a summary of that is to go to www.plan.com, if I'm not mistaken. Nope, it's plan.ca. The Lifetime Advocacy Association has information, and they have it on rdsp.com is their website. Sorry, I messed up. Okay, the Registered Disability Savings Plan there's a Senate release list of improvements of recommendations on the RDSP. The biggest one is that a lot of people can't get the identification they need in order to open a plan. One of the recommendations, the last recommendation that the Senate committee made, was that an automatic plan be opened for every person who qualifies for the RDSP. The challenge would be determining which bank got to do that. Or maybe you'd have to say, when you sent in your disability application form, I want my RDSP at Van City or Bank of Montreal or TD Bank or wherever. But right now, you have to walk into a bank and say, I qualify to open an RDSP, please can we open one up? The problem has been representation, because a person with a disability may not be competent to open their own plan. And the only person who can have a plan is the person with the disability. So in order to access this program, which has matching grants and bonds for low-income persons with disabilities, they get $1,000 a year up to age 49. That's $20,000 of bonds. There's also a $70,000 matching program. So if the person with the disability or their family or friends choose to contribute to their RDSP, the government matches it with substantial amounts of money, $70,000 of matching money. You can put up to $200,000 into an RDSP. The RDSP plan was established to provide a pension for people with disabilities. But if people don't take advantage by opening a plan so that the $1,000 a year can be contributed to it, they're losing out. Now, if you haven't opened a plan, the plan has been open for a number of years. If you open a plan, they retroactively give you the $1,000 a year. That's how concerned they are about the low uptake rate on this program. So if you're listening to this plan, to this webinar, and you know somebody with a disability who should qualify and hasn't opened an RDSP yet, take them to a bank. Figure out how to get a plan opened for them. You'll have to read through the Senate report to understand that there could be some limitations that you may run into, and you may have to find a way to work around that by obtaining possibly guardianship or a representation or a power of attorney or whatever it takes to open this plan up. But losing out on this money, oh my God, why would you want to do that? Now, there's another amount that seems to vanish off the table a lot. And I'll tell you about this. I have a number of people that have come to me over the years to get help with claiming their disability tax credit. And they've been astounded to learn that there is a disability supplement for children under 18. The disability supplement can be clawed back by the amount of child care and attendant care expenses claimed for the dependent by anyone. So some people who pay a lot of child care expenses will not qualify, but if the person for whom you're claiming is under 18 and they don't have a lot of child care expenses, you'll find that the supplement is about $4,500. The $4,500 times 0.2 is about $900 of foregone taxes if you haven't claimed the disability supplement. Now, one of the things that I mentioned earlier, and I'm just going to flip through here to get to the screen that I want. I'm not finding it, and I've lost my train of thought. Okay, let's go back here. What can people with disabilities claim as a deduction or credit? They can claim all of these credits. There's a child care expense, a disability support deduction. Well, now, just a minute. The person with the disability can claim that. Someone else can't. That's a different topic for a different day, but there is the potential to claim expenses against income if a person with a disability has income. There's the list.